All facts and circumstances must be considered. May the company, this is a nice example, may the company in which you hold the potential voting rights issue more share capital without changing the authorized share capital. What if the company has already issued all of its shares and you hold options to acquire another 20% of the share capital? What will have to be done? There will have to be a special resolution before the authorized share capital can be changed and increased. Do you agree? And then only will you be able to exercise your options. So once again, the economic reality is that although these options are currently exercisable, the authorized share capital has all been issued and therefore cannot be, the options cannot be exercised at the current stage, so they are not currently exercisable. They are not existing rights that actually give you the current ability to govern or to direct. So it's also important, not just the existing rights. Yes, the potential voting rights exist. They're currently exercisable. But does it give you the current ability to direct the relevant activities? No, it doesn't, because we cannot exercise them. All right, so those are the important things. My advice to you, think practically. All these rights, are these rights actually substantive? Are they practical? Those are my considerations: financial ability, intention, economic sense of exercising. So the question is, the economic reality, does it make sense that I can exercise these shares? All right, delegated rights. I just want to talk about this quickly because I do not believe that this is such a big part of your current syllabus, and therefore I don't want to place too much of a focus on agents and principal relationships. Let's have a look. If I delegate my rights, I'm the principal that owns the rights, from the start, okay? And then I'm going to delegate that to someone else, and that someone else is called the agent. Now, IFRS 10 specifically says that agents cannot control another entity, okay? So now, what is the issue? An agent is a party engaged to act on behalf of another party or parties, and those parties are the principals. Do you agree? A principal may designate power to an agent, but an agent cannot control an investee. So what is the standard saying? An agent purely getting power delegated to him or her, that does not give the agent enough to control. Can you see? It comes back to our whole discussion. We've got to look at the bigger picture here, all right? So the power instrument, the voting rights, those are not enough to just say that the agent is controlling. Let's have a look. However, if the agent gains benefit from the arrangement, the agent could be regarded a principal and could then control the investee. So what happens here? For example, if I give my voting rights to someone to go and vote on my behalf, who still gets the profit? I do. Do you agree? So the agent is literally just there exercising the power instrument. What does that mean? It's irrelevant. Do you agree? Because that's one component of a bigger definition and the others are not met. But who gets the ultimate outcome or the returns? I still do. But what if the agent is not only given the power to vote at the meeting, but also a certain percentage of the profit that would have been, sort of allocated to me as the shareholder? That part of the profit will now go to the agent. Can you see what's happening here? The agent is exercising its power that it's been delegated, all right? It's exercising that power, impacting on the profit and loss, and that is impacting on the agent's return. All right, so we've got to have the whole definition in place before an agent can actually be viewed as a principal. There must be economic benefit or return in that whole arrangement for the agent before the agent can qualify as a principal. And once you are a principal, then you can go back to the definition of control. So we consider the rights of the agent, the decisions, the discretion, decision-making powers, the range of decisions, the level of involvement, the financial benefit for the agent. All right? Is there a percentage of the profit? So if you consider those things, the discretion, the range of decisions, the level of involvement, the financial benefit, the higher those things, the more likely it is that the agent is actually a principal and can therefore exercise control. All right, so that is basically what you need to know regarding agent/principal relationships. So this is relevant to investment funds and asset managers. To what extent do these people act on behalf of the principal? Okay, that is easy to determine because that's normally contractually agreed. Do you agree? But the question is, what's in it for the agent? What return is in it for the agent that is variable? What if I give the agent a fixed fee for voting on my behalf? The agent is involved, exercising the power. Do you agree? But what is the agent getting back? A fixed fee. Is that a variable return? No, it isn't. So that cannot be controlled. Why not? Because whatever the agent does or doesn't do cannot impact on the eventual outcome of this company, all right? The return, and therefore there cannot be control. So that's how we need to have a look at it. What is the variability? What is the exposure to that variability of returns? How is the power used, etc., etc.? Then we make our conclusion. All right, then on slide number 25, I just want to do a short example with you on relevant activities. A structured entity is formed to manage the debts of a financial institution. Now, what are the activities of the structured entity? Restructuring of debts, debt collection, debt management, legal processes relating to debt management, etc. Ladies and gentlemen, those are the relevant activities. And whoever can control those activities of the structured entity and have a variability in return and all of those things, that will be the party that's in control of that particular structured entity. Now, what's important? What did we say earlier about structured entities? We said that normally the relevant activities, those are the risky activities. Do you agree? The relevant activities are contractually agreed. And that's why only the parties that are given the power to direct by contract will be able to influence or direct these relevant activities. So I wouldn't be looking for voting rights. I would be looking for participation in those relevant activities that was created by means of a contract. All right, because that's how we establish the control. And what brought it all about? The fact that we've identified what the relevant activities are. What if I say to you the administration relating to the activities of this structured entity? We need to keep record, we need to file, we need to do the tax, we need to financially account, the financial system, okay, the financial reporting system. We need to do all of these kinds of things, customer relationship management, etc. Those are activities, and they might be affected by voting rights. You might have all the voting rights over that particular activity, but if it's not the relevant activity, it's irrelevant. All right, and why is this so important? Because a structured entity is created. I think the previous word actually describes it nicer. Special purpose entity. It's for that particular purpose. And once you've established that purpose, that's the relevant activities. And whoever contractually directs those activities, that'll be the person in control. As long as there's that exposure to variable returns, that causal relationship that we've already spoken about. So the party that controls the relevant activities, that is the party that will control the structured entity, given that all the other requirements are met. Let's conclude this chapter on example 2. Just a little example on power. Company A owns 40% of the share capital of Company B. Company B's shares are structured in such a way that every share has one voting right attached to it. Company A also owns options that are exercisable at any stage. By the way, those are options that we call American options. It's got nothing to do with the continent, so don't think there's a type of option for every continent. American options are exercisable at any stage during the option term, all right? Whereas European options are exercised only at a specific future date. So just be careful. Should they mention American or European options, that already tells you something about exercisability of that option. Only American options are exercisable at any stage, whereas European options can only be exercised at a specified future date. And if that date hasn't happened, they are not currently exercisable, and they will not be existing rights that give you current ability to direct. Okay. In terms of which Company A can obtain another 20% of the share capital of Company B, and therefore another 20% of the voting rights. At reporting date, Company A has the financial ability and the intention to exercise these options and acquire the 20%. Does Company A control Company B? Now we know the answer is yes. Let's have a look at how we would discuss it. Firstly, what is the power? What is the power instrument that Company A holds over Company B? That would be the voting rights of the existing 40% plus the potential voting rights that are currently exercisable. Those two together give you the current ability to direct the relevant activities. Secondly, exposure to variability. Company A's profit share will depend on Company B's financial performance. Do you agree? These are ordinary shares, and therefore the bigger the profit, the bigger the dividend. So there's a variability. Why can we make this assumption? Because nothing was said to the contrary. You comfortable? All right, and then lastly, the ability to affect the outcome. The voting rights give Company A the ability to control the decisions made by the board of directors, i.e. the relevant activities are affected by Company A's voting rights. Now, can you see, once those three areas have been discussed in detail, now we can say with confidence in terms of the new definition of IFRS 10 that this is what control is all about. In Chapter 4, this is the area that I would like to just have a very quick look at, because this actually is the same as the concept we've already discussed in IS 27. So that's why I call this a quick recap, because nothing of this is really different to IS 27. But let's do a quick recap nonetheless, because these areas are very important within the topic. All right, firstly, the preparation of consolidated financial statements. If we move to slide 28, you can see a parent prepares consolidated financial statements using uniform accounting policies for like transactions and other events in similar circumstances. So that's the first important point there, and that is that the IFRS that is applied by the parent will normally be enforced also for the financial statements of the subsidiary. Now, if that isn't already done in the separate and in the individual financial statements of the subsidiary, then that will have to be done on a pro forma basis for the preparation of consolidated financial statements. So what you can see happening here is that you would have to go and make pro forma financial accounting adjustments at group level, at consolidated level, to get the accounting policies uniform. Let me give you an example. Let's say the parent in its separate financial statements measures investment properties according to the fair value model subsequently. And the subsidiary in its individual financial statements measures investment properties according to the cost model subsequently. Then at group level, you can't have investment properties measured at fair value and in terms of the cost model, because IS 40 says that investment properties must either be measured at fair value or at cost model, and that will apply to all of them, unless fair value, of course, cannot be reliably measured, which isn't the case in this situation. So then what you would have to do is at group level perform pro forma adjustments in respect of the investment property of the subsidiary and fair value that in the right periods, bring in the deferred tax, etc., make those adjustments, and those are all pro forma group adjustments. All right, so that is brought about by that first requirement where they emphasize that. Secondly, if all the conditions that you see on slide number 28 are met, no consolidated financial statements have to be prepared by that parent. Now, we'll run through them very quickly. The parent is a wholly owned subsidiary. The parent is a partially owned subsidiary, and the other owners have been informed and don't object to consolidated financial statements not being prepared. Its debt or equity instruments are not traded in a public market, so we're not a listed company. It did not file or is in the process of filing its financial statements with the Securities Commission for the purpose of issuing any class of instrument in a public market. So we're also not in the process of becoming a listed company. Its ultimate or intermediate parent produces consolidated